Welcome. I'm Clark Brown with Elevate Wealth Advisory. And in this month's webinar, we have joining us an author, a financial advisor, a professional in the industry with more than 30 years of experience and an expert in the field of behavioral finance. His name is Michael Pompian. Michael, welcome.
Clark, thank you so much. It's a pleasure to be here.
Well, I'm happy to have you join us. Michael and I, we've been friends now for probably about 8 years. And I came across Michael's work about 9 years ago as I was doing some research around the topic of behavioral finance. And there's lots of academic research that describes what behavioral finance is all about, research around identifying various behaviors and biases and heuristics as they refer to them. And we'll get into a little bit more of that as we continue our conversation. But a lot of it was just really around the observation of what it is. And there wasn't very much work that was done, practically speaking, around how investors should deal with those and the ways to work with advisors and coach investors to make smarter decisions. And that was until I came across Michael's work. And Michael had written a number of white papers that I had stumbled across and several books. And it was just perfect for the research and the work that I was doing at the time. So I reached out to Michael. And since then, we have been collaborating together, developing and designing and delivering workshops for financial advisors, mainly to help them help their clients make better and smarter decisions. Michael, give us a little bit of your background. How did you kind of end up where you are now?
Oh, wow. That's a great question. So, gosh, it was back earlier in my career. I was always interested in psychology, generally speaking, how human behavior and things like that. And my education and my career, kind of took me in the direction of financial advisory. And I never kind of lost that interest in psychology. And back in kind of the late 90s, really, I stumbled across myself some literature in behavioral finance. And back in those days, there was really not much attention paid to that subject. There were a few heretics out there like Daniel Kahneman and Robert Schiller and a few others who, Richard Thaler, all three of whom have won the Nobel Prize since. But we're not paid attention to much in those days, who were saying that, guess what? The market isn't rational. The price isn't always right of securities. And it just resonated with me. And so I started reading and researching, and I had this idea that people of different personality type, I had done a few Myers-Briggs tests with my wife and so forth and some other things. And I thought to myself, wow, it just seems like people of different personality types might want to invest differently or receive advice differently. So I did some research on that and wrote a paper on it, and it was published in the Journal of Wealth Management. It was a very exciting time. But I felt like I could do more, that there was more there. And to make a long story short, I did, write some books. Behavioral Finance and Wealth Management was my first and most successful book. Did a second edition of that, but now I'm at 5 books, and my most recent one, called Behavioral Finance and Your Portfolio, is really geared more towards the investor, whereas most of my work in prior iterations was geared more towards the financial advisor. The most recent one is really more towards the investor. It's the same basic ideas and concepts, but how can individual investors make better decisions for themselves or with their financial advisor, of course. But that's how it all got started. And, as you know, Clark, in teaching this stuff over the years, it is very applicable and relevant, really, regardless of what time you're in. People are people, humans are humans, and they behave irrationally, pretty much nonstop, and pretty much at any wealth level too. You can have them, mass affluent all the way up to the uber wealthy. I work with all of these types of investors, and they all have behavioral biases, everyone.
Fantastic. So maybe let's set the table a little bit for our viewers and talk a bit about what is behavioral finance when we say that term.
Okay. Well, so what behavioral finance is basically the application of psychology to investment decision making. And so there are many academic folks for many decades now that have identified certain biases or behaviors that essentially prove that humans make irrational decisions. Daniel Kahneman is probably the most famous one. He invented something called prospect theory, which basically says that humans feel, or investors feel, the pain of losses more than the pleasure of gains. And that's called loss aversion. And that's probably the most famous bias, won him the Nobel Prize, along with a guy named Tversky. But there are many, many others that have been identified in the literature, anchoring bias, mental accounting, and I review 20 of those, what I consider to be the most important biases in my work. And then to further simplify, created 4 investor types that take these biases and apply them to different types of investors. And so that's what behavioral finance is, to me, and how you apply it to either investment decision making, or if you're a financial advisor, how to coach your clients and help your clients. That's behavioral finance, to me. There are other definitions and other applications, but that's what it is in my view.
One of the things I really liked about your work when I first came across it was, and you used the word a moment ago, simple. The simplicity of taking something that is, enormously complex. There's been so many researchers in the world of academia that have put work into this. At one point, I think I stumbled across a list of over 400 biases or heuristics, which, if I understand that term correctly, a heuristic is more of a thinking error. But they were observations of what people do and explanations around why. My favorite, I think I came across, was the IKEA effect. And that was defined as the belief that if you have to put it together yourself, it's a better value, right? So, you go shopping for something, and when it said some assembly required, then I'm getting a better deal because they didn't put it together at the factory. But you identified these 20, and I back to what I was stating, that the simplicity, you broke it down into kind of 3 basic categories of biases that you can use to organize these. Tell us a little bit about those categories.
Okay, yeah, exactly, great. So yeah, one of my probably most significant contributions to all of this topic is the idea that certain biases or behaviors are driven by either cognitive errors or thinking errors, or emotional errors, or how you feel about things. So, for example, loss aversion is really an emotional bias. Why? Because I can't say to you, you shouldn't be concerned with losses. That's how you feel about things. And so it's going to be difficult for me to change how you feel about that. Whereas take a bias like mental accounting, which is what happens in mental accounting is people tend to put money in different mental accounts or actual accounts, such as your vacation money, your education money, your retirement money, and your bill paying money, whatever these different buckets are for people. And then what happens is you don't look at them in a portfolio context, and it's suboptimal in terms of how long-term investing principles. And so I can say to you, guess what? You are suboptimally investing through mental accounting. And somebody could say, oh, okay, actually, I understand that now. I didn't really see that before, and that's really more of a cognitive or thinking error. So there's these 2 different types of biases, the emotional ones like loss aversion, the cognitive ones like mental accounting. And I kind of recognize that these have to be dealt with differently because people who have emotional biases aren't really swayed by quantitative information. Like if you say to someone, well, if your Sharpe ratio of your portfolio is X or Y, you shouldn't have loss aversion. Well, that doesn't work with most people. They want to hear emotional type language. and things like that, versus, as I was saying, like mental accounting, where you can kind of quantify things and people can understand. So, and within the realm of cognitive bias, there are two different types that I've identified. And, one of them has to do with how people tend to cling to ideas irrationally. And, the other one has to do with, I won't get into too many details, but, just basic thinking errors. And so, we have to deal with each of those differently. So we, as investors, we need to try to identify these kinds of thinking or emotional errors and understand that we have them. Now, as an advisor or as an investor, our job isn't necessarily to psychoanalyze our clients or, to psychoanalyze ourselves and say, what are my issues? How am I going to, it's more about understanding them and adjusting for them. So if you have loss aversion, but you have, long-term goals that you want to meet, then you have to just sort of understand, hey, maybe I do have this fear of losing money, but I have to take some risk in order to achieve my goals. So I'm going to try to balance that out. That's really the process. It's less about, the deep psychoanalysis and more about understanding how you think and how you behave and how you feel, and then adjusting, your portfolio, for those behaviors. So, yeah.
Really good. When I hear the word bias, I'm reminded of something that I heard another presenter talk about, that, a bias is somewhat like a blind spot. It's something that, you don't see. And by definition, if you have a blind spot, you're not going to be aware of it. You can't see it yourself. You need someone else to help you identify it or to point it out.
Right.
I recall in conversations you and I have had, just talking about the work at your firm and working with your colleagues. One of the belief perseverance biases, bias, which is the tendency that once we make up our mind, we tend to look for information that supports that decision and will dismiss anything to the contrary. And you described that that's something that in the culture in your office, you'll call each other out on. Hey, wait,
right.
Are we kind of falling victim to us? Talk to us a little bit more about kind of that approach of being able to help somebody understand or see maybe a blind spot they're missing.
Mm-hmm. Yeah. By the way, your audio went silent for a sec there. I just want to say that what Clark was talking about was confirmation bias. And so what happens with confirmation bias is that people tend to seek information that confirms their beliefs, as opposed to seeking information that may be run counter to their beliefs. So the most classic example of that is, sort of political news channels. So people who are, on the left tend to watch shows that support those beliefs, and people on the right tend to watch their shows that support their beliefs. And, it does happen, but rarely do you really see the opposite happening, where, somebody on the right is watching, MSNBC and getting the opposite view opinion, or vice versa. So it happens all the time in investment decision making, and that's the thing that we tend to watch out for as a group here. If we think that interest rates are going up or down, or inflation is going up or down, we'll bring evidence of that, to a meeting or to a conversation, but have you looked at the counter or the opposing view of, maybe inflation is going up faster than we think, or whatever the case may be. So we try to call each other out and say, have you looked, at the opposite view? So very valuable in the work that we do, and keeps things balanced. So
really good.
Yeah.
So you mentioned earlier the behavioral investor types and the models that you've developed there. Mm-hmm. Talk to us a little bit more about what those are and what that means.
Okay, happy to do that. So back to the cognitive versus emotional distinction that we were talking about earlier. So when I developed the 4 types, and I'll explain what those are in a minute, what I noticed was that certain investors tended to be more emotional than others, and some were more driven by cognitive errors. And so what I found was that, people at the highest level of the risk tolerance spectrum and people at the lowest level of the risk tolerance spectrum tend to be driven by emotion. So, for example, when you see an investor that has loss aversion, that is very conservative, doesn't want to lose money, what are some of the other characteristics that those types of investors might have? And so some of the other biases, tend to be present. Like, for example, another bias is status quo bias. And what that is that people don't like to make a lot of changes, just averse to change. And that tends to happen with lower risk tolerance investors. In other words, no, I don't want to make any changes right now. No, I don't want to put any money to work. I just want to keep things the way they are. Endowment bias, where the classic case is where if you get you inherit a stock. I've got a current client situation right now. It's the classic case where this particular client's daughter has a trust and had inherited some bank stock from the grandfather. And there's a big chunk of it in this trust account. And I said, it looks like the bank is a pretty good one, so I'm not, going to recommend that you sell right now or trim it. But that's something that could happen in the future. And he said, well, just remember that was something that was given to her by her grandfather. And, we have an he literally said that we have an emotional attachment to that stock. And, that's the classic case of irrationality as it relates to an investment. That's called endowment bias. And that tends to happen with, more conservative investors. So conservative investors tend to be driven, not always, by emotion. Kind of flip it to the other side where you have the most aggressive investors that can be driven by emotional bias as well. So, for example, overconfidence. People have made a lot of money in business and think that they can make a lot of money by being bold and brash and overconfident in their investment decisions. Are often humbled by the markets because you don't have as much control. Illusion of control, excuse me, is another one that happens. Another bias that happens at the upper end of the wealth spectrum. Feeling like you can control the outcome of your investment portfolio. Now, if you're the CEO of a company or something like that, and yes, you can have some control, but generally speaking, no one has control over the bond market, the stock market, or any of these other, asset classes. So, high risk tolerance investors tend to also be driven, by emotion. And as I was saying earlier, those are difficult biases to change because they're how you feel about things. And so as an advisor, you have to sort of treat those 2 types of investors a little bit differently than you might other types, which I'll talk about in a minute. Or if you recognize yourself, like, hey, I'm one of those types of people, you may, want to understand that emotion may be driving your decision making, and think about that when you're either doing your own decision making or working with your advisor. When it comes to the other 2 types of investor types that are a little bit less emotionally oriented, one is called an independent, that is really somebody who likes to make their own decisions, likes to do their own research, hence the term independent, but they may get caught up in a few biases, such as the one we talked about, like confirmation bias, where, seeking information that confirms a belief is a classic case, in the independent realm. So, if you're that type of person, you may want to think about that. Another investor type is the follower. And these are the type of investors that, tend not to have their own ideas about investing and kind of follow the crowd. Maybe they don't like the investment process that much. And like a classic case of a follower bias is recency bias, where you're looking at the most recent returns and saying, hey, I need to be involved in that, not necessarily paying attention to valuations. So if you're, looking at the markets going up and up and up and up and invested a lot of money, middle or late 2021, you weren't paying attention to the valuations necessarily. And now look what's happened, in this year. So, you definitely need, especially like on the NASDAQ side, if you look, oh, NASDAQ's going crazy, Amazon's going crazy, all this stuff, and you jump in, the NASDAQ was at a over 2 standard deviation valuation over the past 12 months, meaning two standard deviations expensive. And I had a client that was asking me, a very wealthy client, saying, hey, let's look, when you look at the NASDAQ returns, it trounces the S&P 500. We should be in NASDAQ. And I said, well, yes, except that we kind of, it's the valuations have made it such that, we'd be very vulnerable to a correction. And so he said, all right, well, let's start tracking it. And so we kept tracking, the valuation level versus history of the NASDAQ. And we have a rule that if it gets down to a certain level, we buy some, but it never got down there. It's getting closer now, but it's still, fairly expensive. So, you need to have this kind of discipline in your process so that you're not making, these kinds of, bad decisions. So.
Yeah, I think that last bit there is key. And it's especially difficult for the individual investor who may be sitting there at their laptop on their TD Ameritrade or Schwab account late at night, looking at charts and seeing, these accelerating lines and thinking, oh, this is right. I need to jump in right now. And what they're doing is jumping in at the top. I recall I had a friend here in Athens who was a day trader. That term was really popular back in the late 90s. And he had inherited a bit of money, probably about 1998. And I remember him saying to me, I have figured it out. On it, back tested, using Yahoo Finance, all of these charts on about 10 stocks, which were all .com stocks. And he said, I have found that if you buy these stocks between March 15th and April 1st, and then sell them between September 15th and October 1st, over the last 5 years, you'd have a 140% annual compounded rate of return. And I remember thinking to myself, do you think that's how it works? And he was all in, and unfortunately, March of 2000 rolled around and the tech bubble burst, and it was not kind to him. But he was definitely a herd follower and a little bit of independent there too, because he was trying to do his own research. But, as you said, confirmation bias, he kept looking for information that would support what he was saying. And
right.
Punctuated the last part of your comments there. How do you deal with that? How do you overcome that as an investor? And it's about process and discipline. That you do the due diligence to recognize, is the value that this security trading at fair, given all of the fundamentals about the company, where we are in the economy, where we are in the business cycle. It's not just looking at, the slope of the line that got it to where it is today.
Yeah, no, that's a great question. So the best phrase that maybe was ever said, there's like 5 or 10 of these like very pithy comments that people have made over the years. But Benjamin Graham said, in the short run, investments are a voting machine. In the long run, they're a weighing machine. And, things can get irrational. And then the other one is, John Maynard Keynes said, things can stay irrational for longer than you can stay solvent, is another one. But things can stay irrational for many, many years. So, and this business is inexact. You're never going to get exactly the right allocation at exactly the right time. And that's why you build a diversified portfolio, because you're going to be wrong on certain things. And diversification, especially now, I think going forward, is going to be probably more important than ever. Over the past decade, you just had to be in stocks and bonds, and that was it. You were good. S&P 500 and Barclays Ag, was fantastic. Now it's reversing. Bonds are actually doing worse than stocks this year, and diversification, I think, is going to become more and more important. So, a lot of these biases, these behaviors, can be overcome with discipline, just a disciplined process of how you do things. And you do have to have a stream of solid information about the economy, about the valuations, all this stuff that you need to make good decisions from typically an advisor. Or you can find all this stuff by yourself, but it's a lot of work. And doing it in a vacuum, like by yourself, is not always easy. So discipline is the key to long-term investment success. And a lot of these behavioral issues that we're talking about can be overcome by a disciplined process. So it's regular reporting, regular meetings, regular evaluation of your allocation, et cetera. So that's really the key to a lot of overcoming these behaviors. But understanding them and adapting to them is also part of the process, and that's also very helpful, because if you understand what you're susceptible to in terms of decision making, you can catch yourself saying, hey, wait a second, is that confirmation bias? Am I doing mental accounting? So educating yourself on these things is important. And my book is a place to learn those things. There are many other resources out there as well.
Really, you talked about those kind of great one-liners or lessons from great thinkers. Read an article recently that talked about heuristics, this term that we use to describe biases that are more on that cognitive side, where the author described it as they're mental shortcuts we have, because we really don't want to spend a whole lot of time. We want to get to a decision quickly. So, we'll shortcut things to get there. And the author referred to SMART heuristics as, well, what are shortcuts that can keep you from making a mistake? Those little kind of checkpoints. I'm looking at the chat box here. We've got a couple questions coming in. And one question is, what is a mental shortcut or a check to check your emotions when making decisions? Any thoughts there?
Yeah, I think one of the most kind of fundamental questions that one can ask oneself is whatever is coming across my mind, is that a thinking bias or a feeling bias? Like, is that something that's coming from my heart or from my head? And if it's coming from your heart, i.e., it's like how you feel about something, like I don't like losing money. That's how you feel about it. Or I am attached to this stock. Is that how I feel about things? Versus like, am I thinking about this correctly? Is another kind of filter that you can use to assess the type of bias that you have. And then just understanding in the biggest picture sense, how you feel about something is often more difficult to change than how you thinking about things, something. So that would be my answer, to that.
Really good. Got another question here. Let me see. Actually, it was a message from my producer here on timing. Okay. And I think we're coming up close to the end of our time. Let me get to this last question here. Okay. And that is, again, kind of as I read this question, the thoughts around maybe just smart rules of thumb, that given a choice, between two things, and maybe you're hung up emotionally on it, maybe not thinking about it. What's a good question to ask yourself to figure out what's the right choice?
So, I mean, on that one, what I would say, confirmation bias is probably one of the most popular, prevalent biases out there. And that's one question that I would, kind of rule of thumb would be, if I'm getting information to help myself make a decision, and I could be just not getting any information to help make a decision. And that's one thing. And that's getting back to the cognitive versus emotional. But if I'm getting information to help me make a decision, what's the source of that information? Is that a biased source of information? Does somebody have an alternative agenda trying to convince me to do something to give me the information? Or am I getting objective advice or objective information? And am I seeking a counter view to that? Back to this idea of confirmation bias. Then you can feel good if you're getting, objective point of view, multiple sources of information, and then you make a decision. That's a good decision-making framework. So that would be a kind of a rule of thumb, is to get multiple views and get objective viewpoints to help you make your decisions.
I like that a lot. One of the things I remember you had shared with me was, one of the simplest questions to ask yourself is, well, if I had cash instead of what I have right now, what would I do with the cash? Right? Would the example of your client with the grandfather's bank stock in the trust,
Right.
Yes, we understand the emotional attachment, but if it makes up 50% of the portfolio, that's a lot of
what you would do
to have that much money in one stock. And the question may be, if grandpa had left you however much money it is, $500,000 in cash, how much of that cash would you put into grandpa's bank stock? Would you put all of it in, or maybe just a portion to satisfy that emotional need?
Excellent. Yeah, I mean, unfortunately, what the real the real world with these situations is these have almost a zero tax cost basis. So you would be triggering a lot of gains, and it's if a stock is rated very poorly, and it's a pretty easy thing to go back to clients and say what you just said, which I think is fantastic, and I've done that before myself. But if you're going to trigger massive capital gain, that's another story. Anyway. But.
Well, as hard as we try to keep it simple, unfortunately, it is complex.
Yes.
Well, Michael, thank you so much for your time today.
You're welcome.
We'll add some links below this video. We'll add a link to Michael's new book, which you can get on Amazon. It's a great read. We'll also add a link to a quiz that Michael has built on his website that you can go through, 10 quick questions, and identify your own behavioral investor type, and some notes and comments and thoughts on how you can be a better investor. But we have really enjoyed our time together, Michael.
Yeah, Clark, always a pleasure. Thank you for having me, and have a great day, everyone.
Thank you. Join us next month when my colleague Chuck Vickery is going to be sharing some thoughts around transitioning into retirement, and really the importance of planning the financial steps you take and the things that you can do to make your money last as long as you need it to last. Thank you, everyone.